This whole system is so broken. It's such a sick joke. I mean, fiat is basically failing as we speak. And it reminds me, I'm a pilot, it reminds me very much of, when you get into, if you're flying IFR and you lose control of the plane, what you tend to do is you want to pull back on the stick, and that tightens up the spiral and makes it worse, and you only crash faster. And what the Fed has done, what Powell has done, is he pulled back on the stick by putting interest rates up as high as they've gone. And you're watching the U.S. interest expense just go parabolic, right? And I mean, this is it, folks. I mean, we're in the end game here. It's obviously going to take a little time to play out. It doesn't happen in days, but it's happening. I mean, there's no going back at this stage.
Yeah. So for people to understand, I mean, we've borrowed another $1 trillion since the beginning of June. Okay. So our debt is up over 36.5 trillion dollars, or I'm sorry, $32.5 trillion. The Treasury just expects, they just put out that they expect to borrow, wait for it, $1.86 trillion in the second half of 2023. That's after borrowing $1.3 trillion in the first half. So,
and that was, by the way, that was 300 or 400 higher than what they projected as recently as 3 or 4 months ago. So
that's right.
It's getting worse and worse, right?
Yeah, and like you said just a second ago, Larry, we're on track to pay about $1 trillion on interest on our debt this year.
Right.
$1 trillion.
Yeah, which is basically larger than the U.S. defense budget. It's the defense budget's in the 800 range. So
that's right.
Yeah, I mean, look at that parabolic rate, right? I mean,
Yeah.
How does this end well?
I mean, I think even like somebody who's not a sophisticated investor, who's not educated in the markets, can look at that interest expense and just say $1 trillion, like that doesn't make sense. And it seems like the rating agencies did say that. Fitch came out and downgraded the government debt, and had a lot of people kind of wondering, is this going to be payable in the future? Like, is this actually a sustainable path? And this is the projection that I pulled from one of James' recent newsletters, but it just looks at the debt held by the public going out to like 2090 over it was 600% debt to GDP. I mean, how could they not expect it to get downgraded?
The best part about this chart right here, and hat tip to Lynn Alden, who was the first one to find it, but this was actually this was published by the Treasury, and it was in a report. It was the State of the Treasury report, and it's basically a love letter, hate letter to Congress, saying, this is the path we're on, and it was. That was not my subtitle. That was their subtitle to the report, an unsustainable fiscal path. And they know it. They absolutely know it. And they're trying to get Congress to look. The Treasury, they're the bank account. They're the banker. They're like, they're like the money manager who's trying to get the rock star to stop spending so much money. He's going to be broke. That's who they are. And they just have to keep issuing debt in order to pay for everything that Congress has agreed to purchase. And so, they understand that this is just not mathematically sustainable. And so that was their report. And it's just incredible how we're, and then what you just said, Sam, about Fitch taking notice. Well, Fitch got on board with the S&P. Basically, the S&P downgraded the U.S. debt back in 2011. Is that correct, Larry? And so what happened there is they saw what happened in the Great Financial Crisis, right? So the S&P watched what happened in the Great Financial Crisis. They watched all these banks. They watched the Fed step in and expand the money supply, and they knew that this issue of the debt ceiling is not going away. And so every single time that we bump up against the debt issue, the debt ceiling, it becomes a political football between the two parties. They both are raising the debt ceiling. They don't care, but they're trying to trick the other one into making a mistake that would cost them votes with their own constituency. There it is, So every single time we bump up against a ceiling, we raise it. It's a farce that we even have a ceiling, but it's supposed to be there to keep us fiscally responsible. Obviously, we're not, and so we keep raising it. So what just happened with Fitch? Well, Fitch said we did it again. This spring, we bumped up against that debt ceiling again. It got so bad that we got down to like $30 billion, which they spend before we have our first cup of coffee in the morning. And they were in almost panic mode. And they said, okay, we've got to raise the debt ceiling or else we default. And they're not going to hard default. No country who issues debt in their own currency would hard default. They'll just print more money and monetize it, right? They'll buy their own debt and make it like it's monopoly money. And so what Fitch is saying is that there's a high probability that we bump up against this debt ceiling again, and we do default. We have a technical default. And when everybody says, and I hear everybody on the internet and all the experts on Twitter say, oh, but it's no big deal. It's not really a real default. It's just a technical default. Everybody gets paid. But you're not thinking through what happens on the other side of that trade. If you're a major institutional investor, okay, and you've got $100 million worth of bonds that are coming due, or $1 billion of bonds that are coming due, and they're not paid, well, you may have borrowed against that. You may be using it as some sort of collateral to some other trade. You may be expecting that cash to settle another investment. You may be making private investments and have sent money and expect this money to come to you in order to pay that. And when it just doesn't show up for a couple of weeks, it's a massive problem. And if you go back to 1979 when this happened, and Larry, you may remember this, it was before my investing time, but it was a disaster. The Treasury wasn't set up to send money instantly and fix this problem, right? And so they had to physically put checks in the mail to send out to investors because Congress took too long. They settled their difference at the last minute. They had a technical default. They made everybody whole, but it was a mess for weeks there. And then spreads blew out because of it. It's not a non-event. And I'm sick of hearing everybody saying it's a non-event. It's not a non-event. This is a major deal when we trip that debt ceiling and we default, even if it's a technical default. It's a problem. It's a problem for investors. It's a problem for the U.S. debt. And it puts a big spotlight on the fact that we are incredibly fiscally irresponsible. I'm going to get off my soapbox now.
Well, I think that's right. I think the important thing is that the world is watching all of this very carefully. And as an example, you've got a BRICS currency, meeting coming up on August 22nd in South Africa. And, who knows what they're going to say, but they might say that, they're looking for alternatives to the dollar, and that, there's been talk that maybe gold will be one of them, and so on and so forth. So, the entire world watches the way that we behave, and we're behaving incredibly irresponsibly. And yet we have to, because you can't taper a Ponzi, as Max Kaiser points out. And so, although Powell is trying to do the impossible, which is calm down the monetary excess, which they started when they printed 42% of the money supply in a 2-year time frame, he's not going to succeed at it. He has to fail, or if he wants to make the dollar money good, he has to completely crater the leveraged economy that we live in today, and we'll have something that'll look like the 1930s. And of course, we know that won't happen. So really, the only issue is, we're now bouncing up against the deflationary guardrail. M2 is shrinking for the first time in a long, long time, but things are starting to break, and we saw Silicon Valley Bank break. And if they'd wanted to have real capitalism, what they would have done was, they would have followed the black letter law that was laid down in Dodd-Frank that says those wealthy depositors and venture capitalists at Silicon Valley Bank, they should take a haircut on their deposits because the managers of that bank fucked up. They bought low yield, long duration securities that were deeply underwater. And so what needed to happen, if we wanted real capitalism, is they needed to let Silicon Valley Bank fail and let those depositors get a haircut, because that's what the law said they should have done. In fact, what they did do, of course, because they knew there would be contagion, they knew the entire system would come unglued, is they came in with a BTFP and they bailed them out, and they effectively, whether you call it QE or yield curve control or printing money, it doesn't really matter. The fact of the matter is they did what they've been doing since 1987, which is to say they bailed out the irresponsible. And as a result of that, and then they put it all back in the can, and now everything's supposed to be good. And we're supposed to go forward. Stock market's going to rally. It's all great. But here's the issue. It's going to happen again. And when it does, we've seen it over and over. I can cite 20 instances of where, when the rubber meets the road, the Fed fulfills its initial guideline. When it was set up in 1913, it was meant to be a lender of last resort. And it didn't take them but 3 years, and that's what they became in 1916. They funded World War I by printing money, and they weren't supposed to. And guess what? They've been doing it ever since then. Over 100 years of, when the rubber meets the road, they will print the money, which is why James and myself, and I know you too, Sam, are just so absolutely comfortable that monetary debasement is inevitable. It's just inevitable. The only issue is, which way. I mean, as I like to say, they're driving a clown car on an icy road, and they bounce off of two different guardrails, massive inflation and massive deflation.
And they're steering the car, looking in the rearview mirror.
Yeah, that too.
Yep.
Yeah, right. But other than that, it's all good. Other than that, they're geniuses. They've got 300, 400 PhDs who work at the Federal Reserve. The Federal Reserve governors make $400,000 a year, and they get to front run the rest of us, like my classmate from Harvard Business School did. The guy who was running the Dallas Fed, I'm forgetting his name now, but
Robert Kaplan.
Kaplan, exactly. And trade the S&P 500. And of course, he lost his job over that. But that's just that's par for the course. And the rest of us plebes, we have to deal with this money that they're effing around with 24/7 for all of our lives. And they've hurt innumerable people and innumerable families, people losing their homes, people getting over leverage, just all kinds of things. I mean, this is a criminal system that is incredibly unfair to people throughout the entire world. And it's why it's absolutely essential, in my view, that we've got to fix the money to fix the world.